This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's a countdown to chaos as an economic storm larger than the global financial crisis is on the horizon. And what you're hearing from policymakers, politicians, economists, and even other experts is that the U.S. economy is strong and that it can survive any sort of downturn because of the labor market. There's plenty of demand from employers for labor. We see that workers are able to command higher wages, and that alone is the difference maker between us and the rest of the world. But what if the labor market isn't as strong as everyone thinks? Well, that's what we're doing at the ADP corporate offices today, because they just issued their private non-farm payroll report ahead, of course, of the government's report on Friday. And we've got questions because when we take a look at what's going on in the data here, it tells us that the labor market is nowhere as strong as people believe. Let's over to Bloomberg, where we picked today's story up with a headline: as poor Americans tap debt, buy less food as consumer cracks widen. Now, and this doesn't make any sense. We shouldn't be even seeing headlines like this, because if the labor market was as strong as everyone says, and there were jobs available and higher wages for everyone, then you could see people finding those wages. They shouldn't be struggling as much as inflation comes down because there's opportunities for them. But we're seeing, in fact, the exact opposite happen. Among households using the Supplemental Nutrition Assistance Program, or SNAP, boosted pandemic benefits, 42% skipped meals in August and 55% ate less because they couldn't afford food, more than doubles last year's share, according to a Wednesday report from Propel. The data also highlights that households were worse off in August from just a month ago. Now, if you think back, we just talked about in June, what did we start to see in the data? That households were running out of money and into July, and now we're seeing it's getting worse in August. And again, this doesn't make a whole lot of sense, because if we're just experiencing a soft landing here, then what this report should say, you know what? People are struggling right now, but the opportunities for them are endless. There's just so many jobs. There's so many employers that are desperate to pay higher wages that it's just a matter of time before the financial situation for these people gets better. The problem is, it's not. In since July, an increasing share of low-income households had utilities cut off, couldn't afford the prior month's utility bill, or couldn't afford rent even. Again, adding to the narrative that something changed in June. More than two-thirds of these surveyed who were receiving boosted SNAP payments said they had some form of debt. So here we have an issue. They can't pay their bills at all. And this all started back in June, and here we are in late August and going into September. Everybody still broadly believes the economy is doing pretty good. In fact, what do we continue to hear from Fed Chair Jerome Powell? That the labor market's so strong that he wants to throttle it back even more. The problem is, I don't even think that Jerome Powell realizes just how weak the labor market is, and that it's signaling a major storm is on the horizon. The U.S. economy is fairly well, but there's a lot of hardship being experienced by people with lower incomes right now. The report adds that other recent data indicate an erosion in consumer finances and sentiment, which we've talked about recently here, particularly among the lowest income households, as labor market demand cools. Now, wait a second here, as savings wind down and pandemic social support expire here, which is part of course, the case that, hey, you know what? These people have been using the programs here, and maybe now it's time for them to go out into the labor market, but that shouldn't be an issue. Of course, the report suggested that problems in the labor market, demand here is cooling, and this is a big effect, because we're going to take a look at exactly why things are slowing down in the labor market, why the economy is slowing down, and why the Fed can't see this major economic storm that's just off the coast of our country right now. And here we can see this from Wall Street Journal: as the job market cools, but is far from freezing. And that doesn't matter, because in a debt-based economy, all you have is this expansion of credit and debt during these bubble situations. And all it takes is a bit of a pullback to pop the bubble. You don't have to have a major deceleration. You don't even have to have a contraction. You just have to have the economy slow down enough to where people aren't making enough money to not only pay their bills, but to cover their debt and to provide enough money for the the economy to continue to grow. So the fact that the labor market here isn't freezing isn't the issue. The problem is it's slowing down a lot faster than most realize. Now we're looking back to yesterday's data a little bit because I want to make some points here with it. As the Labor Department yesterday reported, there was a seasonally adjusted 8.8 million unfilled job openings as of the last day of July. So we come back to the story on those SNAP payments and say, well, wait a minute. If there's 8.8 million jobs open and employers are demanding them and there's higher wages, then why is the problem here? What we should, again, hearing from these studies and these reports is, yes, these people are struggling now, but there's opportunity for them and the situation for them will soon change. But we're not hearing that, and there's a good reason why. And what we can see here, that there's still a ton of openings. 1.5 for each person count as unemployed in comparison with an average in 2019, a good year for jobs of 1.2, suggesting that the work of the Fed isn't done yet. But that still counts as a fresh sign that the job market is in fact cooling, which it is. And as we look ahead to the non-farm payroll report, which we're going to get a snapshot here when we talk about what's going on with the ADP report, I want you to kind of see a preview of why yesterday's job openings and labor turnover survey data is so important. Now, I had to cut off the pandemic data here so we can actually see the lines, but let's go back and look at, of course, the JOLTS data. That's shown in blue. These are job openings. You can see it decelerates as employers cut job openings during recessions, as shown in the gray shaded area. But now we've got the total non-farm. This is the government report that's coming on Friday, shown in change of persons. And so no surprise, as job openings vanish, well, what eventually happens is you see a slowdown in hiring, and then you eventually see a contraction. That's that green line. That's where we see the non-farm payroll report. Let's go back to the chart, go from a positive to a negative. So it's not really a surprise here that we see a slowdown, which I'm going to make the case in the Friday report coming up. And we put this on a year-over-year rate of change so we can kind of add back in that pandemic data. What you can see again is job openings, they start to go away, and then over time, shortly with a lag, what you see is hirings start to go down and then contract. You see here again the red line shown on a year-over-year rate of change, making the case that the Friday non-farm payroll report is going to show perhaps a meager amount of jobs being created. And of course, what we know, policymakers are going to celebrate this, saying, look, we've been tightening monetary policy. We've been raising interest rates. This is what we want to see. The challenge here is, and I'm making the case, is they're not going to have the proper effect. They think they can tap the brakes, bring the job creation down a bit, and it's because there's so much demand that they're going to hold it there for a bit, let off, and then job creation is just going to accelerate and the economy is going to boom. We're going to make the other case here that they're tapping way too hard on the brakes because they don't understand how the monetary system works. And this last kind of celebration of what may be just somewhat of a decent payroll report is about to go negative. And that's the economic storm that we're warning about that nobody tends to see is coming. And one reason why employers might be refraining from layoffs, even as profits over the past year, which we're going to talk about in a bit, and many sectors have weakened, and I'm going to make the case they're going to continue to get weaker, is a worry that the people they let go might never come back. And demand for workers is still strong, especially in areas such as healthcare and leisure and hospitality, which have only up until recently started to see some wages go up. And that makes it easier for people who are fired to find new jobs. And if the economy avoids a recession, we'll put that as a big if and a highly unlikely if, and keeps growing, understaffed businesses could miss out. Of course, what the opposite effect is, what if we do have a recession and these understaffed businesses are actually properly staffed and the overstaffed ones have to lay off? Well, that will continue to put downward pressure on wage growth, will send people packing on the unemployment line, which is, again, the case we're making today. And here we can see now, putting this in perspective, that perhaps the labor market isn't quite as strong as everyone believes, because we look at the behavior employers. What we notice is they're cutting job openings. Well, what would be the next thing that happens if they're cutting openings? Well, there would be hiring less, which we see, of course, that in the red line. And if you don't have as many job openings and you're not hiring as many people, well, what does it tell you need to do with the employees you have? Well, not pay them as big of raises. And that we can see here here in green, which is total compensation, that taking the average weekly hours multiplied by the average hourly earnings of production and non-supervisory employees. So that would make sense that we're not going to see the robust wage gains that we've seen in the past. Now, last month, there was still some optimism that, hey, compensation was looking good, but I have a hunch that that's going to start turning down here because employers, well, they're telling us very clearly they might need employees. They might need specific employees, but they really don't need them as bad as, of course, the policymakers are looking at the data and saying they do. And that tells us now as we head over to the ADP report, as U.S. companies add a mere 177,000 jobs, the smallest gain in 5 months. Now, this is a big shift of what we're hearing from these payroll reports all of a sudden. And one thing that shouldn't be experiencing the smallest gain in 5 months, well, that'd be your trading account. Because if you signed up for our CTA-Timer Pro report, I'm going to show you another trade setup. We've been talking about this one for a while. It just triggered. It changes how you trade. Look at this. Let's talk about the bond market. We've been telling our subscribers there's this big sell-off. The machine positioning was very skewed, all negative here. And as of yesterday, we got the first signal. This would be your buy at open. This trade is now up a little over 1% since yesterday. And look at this. Here's the signal right here. The machine positioning was maxed out shorted. And on that, we run a secondary historical overlay to tell you that this is an extreme position that you need to watch for. And here it was on August 29th, just yesterday. The machine started short covering on their fast algorithm, giving our subscribers that ahead of knowledge here to get in and start taking positions and take and buy in if it continues to rise. And you could have the same access they do for a mere $30 a month. Link in the description below. There's a 14-day money back guarantee, so you get to try it. And when you like it, you're going to see it'll change how you trade. And that all comes back to the payroll report, because everybody's going to need as much of an advantage when the market eventually heads lower. As private payrolls rose by 177,000, this from ADP, not from, of course, the non-farm report that we'll have on Friday, in August, following an upwardly revised 371,000 increase in the prior month. And the median estimate was 195,000. So we're seeing now the experts are kind of missing it to the upside. As hiring in leisure and hospitality, a main driver of growth during the pandemic recovery, was the slowest since March of 2022. But despite the slowdown, no sector shed jobs, and the largest gains were in education and health services, which would make sense as school heads back now, as well as trade and transportation, perhaps giving us some sort of nod that we're going to see in the data here at some point trade increase, which would be a positive sign, but perhaps this is maybe just a false positive of what is to come. The figures on the heels of a decline in job openings illustrate a labor market that is gradually downshifting, which of course we've been making the case here for a while. Though many employers are reluctant to shed jobs, at some point they're going to be forced to. Some are scaling back hiring, while others, are cutting hours to reduce costs. So you start to look at this and say, wait a minute here. If things were so good and employers are making a ton of money, which, mind you, you have to understand from the government's perspective, from these policymakers and politicians and everyone else like them, they think that corporations have some endless amount of money to pay people. I know they don't get it, but look at this. What did this just say? Let's go back and note here. While others are cutting hours to reduce costs, well, that's the first step in what you see of eventually laying people off. And we can look at average weekly hours of production and non-supervisory employees. If you ever need a signal that tells you, wait a minute, we're probably headed into a recession and there's going to be layoffs, this is it. When employers say, look, we don't want to lay you off, but we just don't want you to work as much, well, that's a big indication. Here you can see every recession. We're talking data going back to the 1940s. You see average weekly hours get cut, recession, cut again, recession. You see it happen again, here even in the 70s, the mid-70s. How about the 80s? You got it. Even in the early 1990s, going into the dot-com bubble. Look at this. Every time employers started cutting weekly hours, we headed into a recession. Here again, you see it now. We'll have the official update on this number, of course, on Friday. And those dynamics are contributing to a slowdown in wage growth. Well, that's not a surprise at all. If employers say, look, you know what, we don't need you as much because we're cutting your hours, because we don't have enough demand for our services, and well, we can still maybe give you a little bit of a pay increase, but we don't need to give you much. We just need to keep you around. And I'm going to make the case here of why, of course, we're seeing a slowdown in, of course, wage growth. Now, again, the government doesn't get this. You know, you hear from Jay Powell, and he talks about this wage price spiral, this endless amount of money that companies are going to give people because there's such a shortage of employees, and they're going to pay for it in a big way. And as wages go up, it will lead to more and higher consumer prices. The problem is he's got it completely backwards. And here we can see workers who stayed on their jobs saw a 5.9% median pay increase in August from a year ago. For some reason, the smallest advance since 2021, but we'll show you why. For those who changed jobs, a median rise in annual pay was 9.5%. And of course, it makes sense. We know corporations don't have an endless supply of money because what they generally get their wage increases from is charging their customers more. And so when you start looking at the average hourly earnings of production and non-supervisory employees in blue, and you compare it to the consumer price index in red, both shown on a year-over-year rate of change, it makes sense. It's very hard for companies to give out wages and still maintain their profit margins, which we'll look at in a bit, if inflation is indeed cooling off, which I expect we'll see, and we get the next report here in a couple of weeks. So what we can tell here, as consumer prices go down, well, lo and behold, no shock, employers just don't have the money to give out these big wage increases. So again, we have kind of the opposite effect of what Powell's thinking about. Prices come down, wages come down. It's not the opposite. It's going to lead to layoffs, as you'll soon see. And now when we take a look at total compensation, of course, this is the one that these experts never look at. It all of a sudden makes more sense now when we bring in average hourly earnings, just because those are rising a bit. Well, weekly hours are getting cut. We now look at total compensation in blue. We can see that does indeed lead the consumer price index to the upside. Now it's leading it to the downside, suggesting that, as we now know, the consumer price index is coming down, and that should lead to an increase in initial claims. And lo and behold, slower U.S. job growth should support the Fed's patience. Of course, that makes perfect sense. If job growth is slowing, well, then the Fed should be cutting rates here, perhaps stopping their hiking cycle. I'm going to make the case of why the Fed should be already cutting now, but it's too late. They're missing the whole picture here because they're fixated on the wrong data. Employment growth in the world's largest economy probably cooled, and wage increases moderated in August. Of course, we'll find out more on Friday, suggesting a further tempering of inflation risks. No surprise, that reduces the urgency for another federal interest rate hike. And again, this makes perfect sense. If employees are making less money or their wage growth is slowing, they can't spend as much, particularly against inflation, and that can't drive consumer prices higher sustainably. We know this, but of course the experts don't. And sure enough, what this means is when we look at total compensation, now overlay the federal funds rate in red, without any surprise, you kind of notice this trend is when total compensation growth slows, again, this shown on a year-over-year rate of change, the Fed normally ends up cutting rates. And why? Because it's just indication demand is slowing down. We see this over and over again, except now we see total compensation growth slowing, and the Fed saying, look, it's not slowing fast enough. You're still making too much money. And arguably, people today don't believe that at all. They're still struggling to keep up with inflation. Maybe for 1 month, they get somewhat of a reprieve here. And in the government, that's a big deal, but it doesn't actually make a difference for all those months we were far behind and people had to rack up their credit cards, which, as we know, raising the federal funds rate causes credit card payments with the minimum payments with a too much lag to go higher, still not giving households the breathing room they so desperately need. And what this all turns into is, what is the cause of this problem? Well, it all stems back to the Fed. When they invert the yield curve, we know that money creation slows as banks tighten lending standards. And no surprise, you can look back and see total compensation growth when the yield curve inverts. We see here the red line, now the inversion shown anywhere it's below that horizontal black line. We see the inversion, money creation slows, wage growth comes down. Total compensation growth slows here again in the dot-com bubble. We see it into the global financial crisis. We see it going in the pandemic. We're seeing it now, and it makes perfect sense of what's going on here and why, of course, these policymakers can't see it. They see a big rebound, that the labor market's strong. We're seeing just the opposite, that is on the cusp of getting to the point where we're going to see an increase in layoffs in a big way. And U.S. second quarter growth rate cut to 2.1% on business spending. Now, I'm not going to go through the details of the ADP report because I want to focus on corporate profits. Remember, if companies aren't making money or their profit margin is shrinking, what's the easiest thing for them to do to fix that problem? Well, if you said lay people off, you got it right. The report also includes the government's first estimate of corporate profits in the quarter. Adjusted pre-tax corporate profits fell 0.4% in the April to June period, reflecting a drop at financial corporations. From a year earlier, profits were down 6.5%. And here we can see total compensation as actually starts to follow corporate profits after tax. If companies aren't making more money, I know this seems almost strange that the policymakers can't get this. If companies aren't making as much money, they can't pay their employees as much money. And lo and behold, what do we see here? Corporate profits after tax without IVA and CTA-DJ on the right, shown in year-over-year rate of change. Well, look what happens. We see, of course, total compensation growth slowing down. Happens every time, my friends. And now let's take a look at this. Put the stock market over it. And what do we see here? That the equity market believes that corporate profits are going to turn around. Sometimes that happens. But notably, when we see, of course, the equity market leading ahead of corporate profits and they continue to fall, well, what happens is the stock market turns corner and reverses and goes down. We've seen that before. I know many of you in the comments say, hey, wait a minute. Why does the stock market keep going up? You keep saying these reports have a bearish implication. Look, that may be true, but the fact is people are still buying in a big way. And of course, ultimately, when we see corporate profits go down, this means the 4-week moving average of initial claims is headed higher at some point. It's just a matter of time before the labor market breaks and we see the economic storm that's hitting the rest of the world get to America. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.